When we were preparing the presentation, we were happy enough to say that after 3 years of M&A practically disappearing from the tables of many tax lawyers, we have to say that M&A is back, and that's a good news. It's very challenging because things have changed a lot in the last 3 years, and the prospects on how to tax plan M&A have changed since the way we used to do it in the past. M&A has been just flat in the last 3-4 years since 2008. Flat means that the size of M&A transactions worldwide has been constantly in the last 3 years at 10,000 billion US. And when we look into 2013, I said that M&A is back, but if we look 2013, it was not a very good year. It was a very good starting. The first 3 quarters were much better than the ones in 2012, but the last quarter was not so good. You see that the capital markets, in many regions, they have already reached the levels of pre-Lehman. I'm based in Spain, and I can tell you that private equity funds are coming to Spain now to heavily invest in Spanish companies because they see opportunities for growing. And also the financing is cheap. Interest rates are very low. The valuation of the companies, the assets, are still low, so there are cheap opportunities for buying. You will see that the main actors in this, which are private equities, they are in a position that they have a window to get rid of old transactions, but at the same time they have money because they have not invested heavily in the last 3 years. And they have pressure for the investors to tackle new opportunities. So they are looking for operations today. If we look into Europe, you will see that there are a lot of distressed opportunities. There are a lot of companies, they are deleveraging, and also the financial system is deleveraging. So if you want to buy real estate, especially in South Europe, if you want to buy non-performing loans, there are plenty of opportunities there. But what we have is an uncertain political and especially an uncertain fiscal environment because things have changed. Could you introduce which are the tax planning challenges, the usual ones we have for M&A?
Just to set the stage on what our job is as a tax professional during an M&A deal. Our job is to reduce or defer the tax cash out during the deal, during the ownership of the target and at the exit. Especially at the start of the deal, you want to reduce actually paying tax because you haven't earned anything yet. So we want to avoid it. The job of the tax authorities is of course a little bit different. They want to earn tax, so those are two opposing forces. If we look at what we see during a deal, of course starts usually with a due diligence. Another point is at the start of the deal, what we are looking at is acquisition costs. So the bank fees, lawyer fees, our fees, whether they are deductible and whether you can use them to reduce your taxation. So Albert will explain a little bit about the current climate which we face.
You will see like India, UK, countries like Spain, they are looking more and more on substance over form. They are looking to business purpose tests, so you have to be careful when putting in place the structures.